Good morning, everybody. Joe Ciaccio here. Today, I spoke to an agent last week, excuse me, and he was with a client, and he was unsure about the non-forfeiture options that are within a whole life policy. Excuse me. And that's just a big old fancy word for additional benefits that they offer a client depending on what they need things for. Almost every company we represent when it comes to final expense or whole life has a cash value. They all do. And then some of them have a paid up portion and an extended term. So today I'm going to tap on all three of them to where you can hopefully use those as a tool and advantage if somebody wants to add to a plan, or they want to make some changes, or they may need money in general. Before you switch anybody, they got a term, they got a whole life, they got a UL, always remember you got to do what's best for the client. Because no matter how you shake it and bake it, it boils down to the client, their family, and the trust they put into us. You must underwrite it a little bit stronger if you're going to switch a policy. You need to dig a little bit deeper than normal, because a lot of times people tend to forget when they're doing an application that something happened. And everything does not show up on the MIB or the RX at that particular date. You could hurt the client later. Now, this policy I'm looking at here is on a gentleman. Is on a gentleman that I sold a policy to for $12,000. Male, non-smoker, $12,000. In the 5th year, he's going to have a little less than $2,000 of whole life coverage. Of whole life cash value. Now, if a client borrows money from their cash value and they pass away and the policy is worth $12,000 and they withdrew money from the policy, they're going to get the money they did not pay back subtracted from the $12,000. So an easy way. They got $2,000 of cash value in their policy. They want to borrow $1,000. The policy is worth $12,000. They pass away and make no payments back on that $12,000. They're going to incur a small interest charge. So when they pass, they're going to get $12,000 minus the $1,000 minus whatever unpaid interest they didn't pay back. That's number one. A lot of clients think when they have the cash value in there, they're going to get the face amount plus the cash value. And what we do, the simplified issue whole life, it doesn't work that way. The cash value builds in there to keep your payments level, and they kind of borrow from here, borrow from there to make sure everything is level to where your payments don't go up. If you do want a policy to where the client will get the cash value as well as the face amount, you got to go to Universal Life or an IUL, and that's called option B. Option A is what we deal with. Cash value stays in the policy, client gets a $12,000 face. Option B, they get $25,000, $50,000, $100,000 face plus whatever cash value is built into the account. Premiums on an option B will cost you a tad more than the regular straight life with option A. So let's say you go to a client's house and the client wants to have you review their policy. Let's say this is the policy you're reviewing. Client says, Joe, I sent the card in, I want to get some additional life insurance. I don't know if I can pay more, but kind of go over with me what you've got. Now, the option is that you can review what they have, see it, tell them what they have, and then write them another policy. Some clients want to know exactly what those numbers are for. So let's sit and say you're basic in the house with a client and they want you to explain to them all these three values there. You're going to tell them that your policy has a value called a cash value. That's money in there, so if you ever need to borrow the money to put new tires on your car, you need to put, you need something with your air condition, You can borrow that money from your policy, and you should pay it back to where you get the full face amount. Second option is that the client says, Joe, I cannot afford the policy no more, and I'm broke, I can't afford no more. What's that option there? In the paid up edition, paid up life insurance on 5 years, they're going to get $2,740 from that $12,000 policy. They make no more payments. So they can say, Joe, you know something? Why don't you give me that $2,740? I'll make no more payments. Let me lower my premiums and get a brand new policy. And sometimes they'll add up to almost $12,000 what they had before, but yet they're making smaller payments. Depending on their age, you got to kind of play with the numbers. Hopefully they've got a carrier that's got real high premiums, shows a higher number here, and you put them with one of our carriers that have got less expensive premiums to where hopefully it'll be a wash to make them happy. The third item is extended term coverage. On this particular gentleman here in year 5, he's got 3 years and 307 days. 3 years and 307 days, which is almost 4 years that he can make no more payments, and he's got coverage for the full $12,000. Now, if he passes before the 3 years and 307 days, his beneficiary will get the full $12,000. Some reason he lasts more than that time period, he's got nothing. Okay? So you need to make sure that if he wants to do that option there, what he has, cancer, a massive heart attack, a severe stroke, you got to make sure and educate him to where he understands how this works. What I would do is that when you have something like this here and they have somebody with them, I make up a little receipt for yourself telling him that you advise the client, you got a $12,000 policy, he's chosen to go on the extended term for 3 years and 307 days. He passes before, his beneficiary gets a 12. If he lives longer, the policy will just dissolve and he gets nothing. I'd have him sign that, because when something happens to a family member and that person is there with you, the other person, they may not remember exactly what you said, and you can have a can of worms for you. So let's say you go to the house, they say, Joe, I need more life insurance, you gotta really afford much more. What should you do? The extended term, to me, should only be used if the person has a terminal illness. Something is not going right for them. Okay? If a client's got 1 year or less to live, most carriers will let them take 50% of the face, some take 75%, and some will give you 100% of the face amount up front if they've got 1 year or less to live, and they make no more payments. Well, let's say they want that option, but they want more coverage. You may have to put them with a 2-year guaranteed issue program. Guaranteed, modified, graded, whichever the client, or whatever the carrier uses for their wording for that particular program. 2-year waiting period. I've had one client do that. Did the extended term, because he said, Joe, I don't think I'm going to, matter of fact, his was about 5 years. I don't think I'm going to make it 5 years. Doctor says I don't have much time to live, yet I'm willing to gamble that if something happens to me, I live the 2 years, my kids are going to get the extended term value and the new policy. When you do an extended term and the person wants to do a whole life with a 2-year waiting period, tell them that if you pass away accidentally, your family's going to get that 12 plus the additional 7 or 8 that we're going to get today. So now they're going to get a total of almost $20,000. Let's say the client just wants to get the cash value out. Say, Joe, I'm basically broke. I know I need life insurance. It's something I believe in. I don't want my family left responsible with any of my unpaid bills. Can I have that money out of there and start another policy? And the answer is yes. All you got to do is write them another policy. My way is to get it issued, get the policy in hand, or if you want, deliver it to the client. When at that point that you know you got a policy and there was something that was not done after the point of sale call or the e-app, you feel comfortable, then you get with the client and either instruct the client how to call the carrier to cancel it and give them their money, or you can do a three-way phone call with them telling them what the client wants to do. The client's going to give you permission to sit and talk. Paid up portion. Client wants to get more life insurance. They know they need more life insurance, yet they cannot afford more. So they really don't want to cancel the policy. And let's say, like if this happened here in the third year, you either get $883 in cash or you get $1305. Oh, what I didn't tell you, the premiums are $113 a month. So the higher the premiums, not the higher the face, the higher the premiums, usually the higher these numbers are at the actual 5, 10, 15. This chart here goes all the way from this goes all the way from year 1 to year 40. It tells you all of the stuff here that you're going to need here to use as a tool. I rode with Jack Skaggs, golly, it must have been, I don't know, 100 years ago. We were working in Delray Beach. We had some leads that an agent didn't want to run, so him and I took a boys' weekend out, went there for a couple days, ran some, and we had a lady there who had a policy. I don't recall what the face amount was. She wanted cash. She needed money, yet she wanted life insurance. So what we did was that we pulled out this form here that was in her policy, showed it to her. All I recall was that we got her all her money out, plus we got her policy for $2,000 less. It's the only part about it I remember. $2,000 less. She was ecstatic. She was ecstatic. Now back then when Jack and I were doing it, they didn't have the, I think it may have been longer than 7 years ago. It was when you had to do a wet application, you had to send in a wet check. So luckily, we did everything. We instructed her how to do it. When we got the policy and we mailed it to her, we told her, call the carrier up, tell them my name is, my policy number is this. I want to cancel my policy and please send me my cash value. She got the check about 2 weeks later, called us, and she thought we were miracle workers. So what you want to do is that you want to use these benefits that are for a client to satisfy their needs. If you can satisfy their needs and get them more coverage and or sell them a policy, it's a win-win for both of you. Now, some clients have money and they just want more life insurance. Based on their health, you can tell them you can get the cash value out of here, get this policy face amount or dollar amount, and incorporate that into a new policy because they have money, and sell them a policy, let's say for $20,000, payments maybe the same, maybe $2 or $3 higher, and get them the cash value out. People want that cash value. Yet people do not understand when they borrow from a whole life policy, final expense plan, and they do not pay it back, their beneficiary will have deducted from the face the amount they borrowed and any interest that was charged to that account there. I'm just thinking right now. You walk into a house, client's telling you, I've had this policy for about 5 years, thinking about maybe getting some more, but it all depends on what it costs. I don't care if the client had a policy from 2 months ago, or they got it last week. Always ask them to review it. And what you're doing by doing that, if you're a new agent, you're learning and you're seeing what different policies look like. All policies have the application in the back. All whole life policies have a cash value. Most of them have the extended term feature and the pay up in additions feature. Not all do, most of them do. Looked at the policy, and there have been times where I've gone into a house, they wanted that cash value, yet they wanted life insurance. And they wanted to add to it because what they had was not enough. So I've actually gone in there, underwritten somebody, gotten their cash value out, had it sent to them, and they'll get a policy. Let's say one I recall doing, they had one for $8,000 and they wanted more. So based on their budget, I got it from 8 to 15. So if I would have not messed with the original policy, they would not have gotten the cash value. And the benefit for me was I rolled into a different policy because they wanted that there. Now they went from 8 until 15. Again, you got to be careful when you're doing this here that the client is in good health, because every policy, brand new or you just got last month, has a 2-year contestability. So the insurance company has the right to go back and pull all your client's medical records. They can get all the prescription records. They can get anything they want. Not that they don't want to pay the client, yet they don't want to pay it. They don't want to pay it. And what they'll do is that if the client did not tell the truth, because the client forgot to say something to us, they're going to get all their premiums back. They're not going to get their $20,000. A client of mine called me 2 weeks ago. We're on the phone. How's your health? Joe, my health is still the same. There's nothing wrong with me. I'm taking now allopurinol for gout. Nothing else? No, Joe, nothing else. I said, okay. So at the time, her policy, I couldn't do nothing with, okay? Couldn't do nothing with. So I said, she wanted to add to it. Wasn't no cash value in it. It really wasn't, it didn't do her any justice to do that. Got her on the phone, did a 3-way phone call. Royal Neighbors. Got them on the phone. They said, Joe, we'd like to tell you that your client has been declined. Declined. Got her on the phone. And I said, what didn't you tell me? I said, we went over all the health questions, went over the medications, and you said nothing has changed. She says, oh, I'm sorry. It was Liberty Bankers. She was a diabetic on the pill. She forgot to tell me she was taking gabapentin. She forgot. Gabapentin and diabetes is called neuropathy. Liberty Bankers doesn't like it. So I ended up telling her to hold on a minute, and then I ended up putting her with Royal Neighbors, because Royal Neighbors is very friendly when it comes to neuropathy. So even me, been doing this for 26 years, I felt I extracted all the information from her. I told her, bring me all your pill bottles. This is all on the phone. Give me all your pill bottles. And they forget to tell you something. So what ends up happening, I'm not going to say she didn't tell me the truth. Certain times people apply for life insurance and give that insurance agent all of their medications. When the insurance agent looks at it, gives them a price that's too high, or they're declined. And the agent tells them, as I did, due to the gabapentin is why you were declined, we got to go to Royal Neighbors. So what they're going to do is they're going to be smart, not give you all the medications or not tell you about all the medications so they can get a policy. So you need to tell people up front, what I'm going to do is that I'm going to underwrite it. The insurance company is going to get on their computers and check everything out about you. So the more you tell me about your health and your medication, the better plan I can get you, because the insurance company is going to know more about you than you know. A little bit of a scare tactic to get them to tell you all of their medications. And if you don't do that, what ends up happening is that the Liberty Bankers was $10 a month cheaper than Royal Neighbors. $10, okay? So she had no choice because she needed it and wanted it. If I'd have known that in the beginning, I'd thrown her with Royal Neighbors. Any client that you have that you know they have an issue, you got to put them with the correct carrier off Jump Street. Because what happens is that when you tell a client, I'm going to get you a $10,000 policy, your payments are going to be $50, they're happy with that. They've accepted it. I got to spend $50 to get $10. When you come back and they hear they've been declined or they've been moved from an immediate to a graded or modified, and the price goes up, now what they tell you is, I want to think about it. Yet if you had told them in the beginning the $10,000 was going to cost them $62.50, they never would have heard that $50 price tag. And what they would have done was that they wouldn't have known about it. And they said, okay, Joe, let's go with that $62.50 because I trust you. People buy from you. Sometimes they buy the carrier if they heard it, but most of the time they buy from the warm, fuzzy feeling that you give them, that you're their agent, you're going to be there for them, you're going to hold their spouse's hand, you're going to hold their children's hand when this sad day comes. People want comfort from us, and they want peace of mind for themselves when they lay their head down at nighttime on the pillow, that they're not going to leave a huge expense for their kids. So let me wrap this up. Cash value on the whole life plans, if they borrow, the family will only get the face amount minus what they borrowed and unpaid interest. If you do the extended term, you got to make sure that they've only got a year less to live, okay? And they don't outlive the 3 years and 307 days. If they want the paid up in additions, where they get a paid up policy with whatever number this says, and also these numbers on this form here is at the end of the year. So when you see year 5, that is year 5 and 11 months and 30 days. So it's 1 day less than 6 years. So if you're looking at this here, and the price says here $19.39 to be the exact number, and they're in the beginning of the 5th year, they're not going to get that number. They're going to get somewhere between the 4th year and the 5th year amount. Love you guys. You got any questions, give me a call. Jay says we get a lot more phone calls on agents who are wanting to start Medicare Advantage. They're deciding to take that magical leap because they like the commission and they love the renewals. So if you got any questions about anything, call us. We love you. Hit them hard, and we're here for you. Bye-bye.